I'm excited to host our panel today with a great lineup of friends and colleagues in the space. We're going to discuss a few topics around investing in growth stage. Our speakers today, I'm excited to welcome Ibrahim Ajami, Head of Ventures of Mubadala Capital, and Lauren Kolodny, co-founder and managing partner at Acrew Capital. Just for a little bit of context, Mubadala Capital is the wholly owned asset manager subsidiary of Mubadala Investment Company, a UAE sovereign investor managing over $300 billion. And Acrew is a leading stage-agnostic VC focused on investing in technology companies from the seed to growth stages. Welcome, Ibrahim and Lauren. Thanks for joining me.
Thank you.
Thank you.
And just to kick this off, I think what's very interesting here with this lineup of speakers is how try to get into the brains of investors investing in the later stage growth companies and see how they're positioning their books for this cycle that we're in, a cycle that we haven't seen for quite some time. We were joking a little bit earlier about a lot of people in our space have not seen the 10-year note trading over 5% yield, which has been a very interesting space to be an investor in. Ibrahim, since you launched the venture platform for Mubadala in 2016, which is quite some time right now, especially in the lifespan of VC investing, you invested in over 100 companies and led Mubadala's partnerships with one of the very big kind of technology investors globally, including Lauren's book. Actually, you invested in LP in Lauren. Could you just tell us a little bit more about how you kind of position yourself as a sovereign wealth fund in the venture space? And tell us a little bit about your role and how it's evolved in the last 5 years as the macro has been changing accordingly.
Yeah, sure. Thank you. Good morning, everybody. Thank you for joining us today. I represent Mubadala Capital, which is a subsidiary of Mubadala. For those in the room that have not heard of Mubadala, we're a sovereign wealth fund from Abu Dhabi, but we do operate globally, and we have offices all over the world in many, many different sectors. So particularly this question and this topic today is about tech, and it seems to the whole world and to many people probably in this room that all of a sudden, the sovereign wealth funds just woke up like 6 months ago and decided to invest in technology, which is absolutely not true. We've been very active in technology for quite some time, for over 15 years, and other sovereign wealth funds too, but I represent Mubadala. We've been quite active in technology for some time. But obviously, because of what's happened with the macro and what's happened with we call it the tech reset, the tech recalibration over the past 18 months, the role and the presence and the impact of sovereign wealth funds on the technology scene globally has just become much more real and visible because of the ability to deploy capital at a time when many investors are having a hard time parting with their capital. So to go back in time, we launched our ventures business in 2016, and we made a decision back then is that if a sovereign like Mubadala was going to be active in venture capital, the place to start this business would be in Silicon Valley. We would actually build this business outside of Abu Dhabi. And we did that because it was important for us to be a part of the community, to be a part of, get close to company formation, work very close with partners like Acrew that Lauren represents. And for disclosure, we're also LPs. And so we went around Silicon Valley. We would knock on doors. We would work out of shared office spaces like WeWork, and we would meet a lot of venture capitalists. And there was a lot of skepticism back in 2016, 2017. And it was mostly anchored on two very important points, which was you sovereigns are only active in technology and excited about technology because things are just very good right now. But when things would correct, you would retreat. And number two is you don't really put the founder's journey on your shoulders the way we VCs do that. And we've spent the past 7 years building our business and building it around a very core product, which is we can be a part of the community, we can work with founders, we can support the founder journey, but at the same time, we're backed by the power and resources of a very large sovereign. So our ability to combine a very real face to our strategy and our product, but at the same time have the resources of a sovereign, we thought was a very unique value proposition for the tech industry back then. And you fast forward till today, it's never been more evident, more clear, more powerful, more impactful than what's happening today. Is all of a sudden a lot of the founders and the companies and the partners saying sovereign wealth funds play a very important role in the world of technology. So that's a very high level story. There's many ups and downs. A lot of VCs shut their doors and didn't want to talk to us. A lot of people were skeptical. Some founders didn't really get it, didn't understand why we'd be in it. But I think as time has gone and we've worked really hard and put in the miles, I think the world is realizing that having a sovereign as a part of this tech community and the tech industry at large was really important.
Thanks, Ibrahim. And speaking of working with founders, I think this is a key kind of metric that a lot of founders actually have been looking at. I run the VC side of a multi-strategy crypto fund, and we have a venture fund and a hedge fund. And the hedge fund doesn't necessarily need you to interact with a lot of founders. The venture fund does. And I see our role changing a lot, especially in the last 18 months. And a lot of founders have been kind of asking us a lot of questions about how do I manage my burn? How do I fundraise in the next cycle? So I think what's very relevant today for us as investors is to discuss that part of the business. And I think Lauren led actually the Series A at Chime. We're all very familiar with that neobank. We're all waiting for, a few prospects for that bank at this point. And we were discussing this specific point about her role specifically as a FinTech investor, helping this kind of cohort of companies that were born in the last 7 to 5 years navigate their later stages as they mature. So I would love to hear from you, Lauren, how you guys are working with that at Acrew.
Yeah, the last 12 months, I would say, has really been kind of a year of back to the future, so to speak. I think that there's been a real reversion to fundamentals. The role of the VC has gone back to what it was like when I first entered this business in terms of spending a lot of time really collaborating with the portfolio companies and helping them focus on this fine balance between capital efficiency and achieving fundamentals. I think there are so many companies right now in our portfolio and in every portfolio that are seeing good operating progress and yet are sitting at valuations that are high, and so they need to figure out how to get to that next round of financing or get to cash flow break even. And so that is, I would say 90% of the conversations we're having with our companies are about this, and it's a challenge because those two things in capital efficiency and fundamentals hitting real milestones are not diametrically opposed, but there are a lot of trade-offs, and part of it is kind of being a coach and even a therapist of sorts sometimes. I mean, there are a lot of emotions behind what it takes to get there right now, and people are having to make a lot of hard choices and have really hard conversations with people that they care about and that have meaningfully invested in helping them to achieve their vision. And so that's a lot of what I'm doing right now. The other thing I would say is Acrew is a very thesis-driven firm, and so we spend a lot of time every quarter really doing deep thesis work and thinking about within our thematic areas, FinTech being the one that I lead for us. What are the opportunities coming in the coming quarters and years, and it's been a moment of real sort of deep reflection and work in that regard, and given us a real opportunity to go deep. So happy to talk a little bit about what it is that we're looking at right now later in the conversation. But I would say those are the two things that we're spending time on, and that's different from the growthy cycle of 21.
Thanks, Lauren. And I think the big elephant in the room here for late stages is, it's been a bumpy ride, to say the least. And we think it's probably an amazing opportunity for you guys on the late stage at Mubadala, kind of like having a field day, looking at a lot of companies that kind of held off on raising for the last 12 to 18 months, coming to market, starving for cash. How do you kind of position for that? How are you guys going through that M&A market has been more active than the IPO market, for instance, at least in the US. So I'd love to hear your perspective and how you've been positioning your book, Ibrahim, as you're sifting through a lot of the late stage opportunities come into the picture.
Yeah. So I think that the question, you framed the question as how we're positioning our book. And I think that what we've learned over the past 7 years, to what Lauren was kind of alluding to, which is we have to, as a sovereign wealth fund, it was very important that we identify with the founder journey and that we commit to these companies' journey and work with them, not just as investors, but also as company builders. And I think that's a craft and a muscle that we've built over the years. So, I think when things started changing, we wanted to make sure that we're not sort of also swinging with the entire industry. Listen, the reality is the entire growth sector today is frozen. There's real disorientation. And that's a tremendous opportunity for an institution like Mubadala Capital. We just have a lot of the founders that wouldn't speak to us before, a lot of the companies that we're not raising, they're all knocking on our doors. I mean, that's, it's a special moment for us, but it's also important that we retain our humility and we stay very grounded because of what we committed before, which is we have a lot of founders that we need to support, we need to work with them. We also are thesis-oriented. We identify sectors like healthcare, like FinTech, that we're committed to. So it's very important that we don't swing. But nevertheless, I think there's a very unique opportunity that we're taking advantage of. There's just like this white space now for us to participate in these and valuations have been significantly reset. Listen, I think it's no mystery, and no venture capitalist can say this, that we just all got ahead of ourselves in the industry. We just got ahead of ourselves. Combination of cheap capital, then we moved into COVID digital acceleration, then we moved into SPACs and capital markets. Just all this created somewhat of an illusion that if you have some capital or if you were a founder, then you're a great venture capitalist. And I think the wake-up call started March of 2022 when the entire industry said, well, not really. So we went from digital acceleration to now optimization. There's no more capital available as much as it was. There's still capital, but not like it used to be. And with interest rates now and the cost of capital going significantly higher, the risk lens has evolved for a lot of these investors. So, I think we also have to reset. We have to apply discipline, just like you were saying, Lauren, that ultimately, if you focus on fundamentals and if you believe that these businesses have the right fundamentals, they'll make it through the cycle. But sadly, not a lot of these businesses that have been funded have true, real fundamentals to sustain. So I think the hangover is still in play, and I think it will take some time to clear up.
You did hit the nail on the head. We're going back to fundamentals of return on invested capital.
Yeah.
That metric that a lot of people kind of forgot about a little bit or let it slide a little bit for the last few years. And I would love to hear your perspective, Lauren, about that specific point in the FinTech space that you've been kind of focused on. Like we saw EV softening a little bit, but the market has been actually paying more attention to profitable growth companies that have been doing very well in the payment space. Some neobanks, some crypto companies have been doing very well as well. So I would love to hear your point on FinTech specifically.
Yeah, it's definitely an interesting time. FinTech has clearly fallen pretty hard, but I think we believe that the opportunity ahead is still extremely meaningful. When you consider the efficiency gains in FinTech as a result of technology, they just started to show up relative to so many other sectors. And you can measure this in different ways, but one is GDP per employee in the industry, and so many other major sectors in our economy, retail, industrials, have been really seeing this transformation, the impact of digital transformation over the course of 20, 30 years. And FinTech, we were just starting to scratch the surface. And so I think that a lot of what we've seen over the last decade is really bringing existing financial products online, democratization of access to financial products to consumers and business users that didn't have access to those before. But really, it was hard to bring these financial products to market, and so for many of them, it was a digital face. And now, with AI and other enabling technologies and all of the financial infrastructure that has been built, we really think that that there will be this sort of rebuilding from the ground up, and that provides a ton of opportunity. Obviously, at the same time, as I said, and as Ibrahim was talking about, I mean, we all got ahead of our skis, and FinTech in particular, because of the opportunity at hand, I think there's a flood of capital and flood of tourists into the sector. And so there's certainly a readjustment going on. And I think that a lot of the companies that will do well coming out of this will be agile, and they'll take advantage of the new business model opportunities that come from a high interest rate environment. So a lot of companies, for example, are monetizing if they're holding balance in their depository accounts, they're monetizing on interest. A lot of companies are thinking about how to position themselves relative to the banking crisis. So, opportunity comes out of this time of macro volatility. I would also say from a stage perspective, since I know it's part of what you're talking about, right now we're pretty focused on seed. So we invest from seed all the way to sort of mid-stage growth. But we think that there's clearly a reset happening at the growth stage, and for us, we think that there's an advantage to companies that are, especially in FinTech, building eyes wide open in this environment. Meaning, not only do the founders and the teams sort of come out the gates with the perspective of the need for fundamentals and for building the business in a capital efficient way, but also that they're context aware of the reality of the economy, and so they're actually sort of building to address those pains. So that's where we're focused right now. But I think more opportunity to come on the growth side as these companies continue to adjust and figure out how to who will actually take advantage of the environment that we're in interesting ways.
Thanks, Lauren. I think something that we wanted to discuss as well is we're all here in this environment where the Fed again hiked at its fastest pace in history, and we've been trying to invest through that. They're trying to break inflation, but we are sitting and witnessing a massively deflationary technology that's been developed in front of us, AI. It's kind of that buzzword that we're all hearing, but it's going fast, it's developing fast, and people need to catch the bandwagon or be left behind. And I think what's very interesting to me, I would love to hear from sovereign wealth fund perspective how you guys are positioned to kind of catch this bandwagon of AI, and how are you guys thinking about it in terms of productivity, in terms of investing in specific technologies utilizing AI? Tell us a little bit more about how the work you've been doing at Mubadala for that specifically.
On the AI space?
Yes, please.
Yeah. So this is obviously, it's a big turning point for computing and for the industry at large. But many of the VC investors, including us, and I'm sure you, Lauren, have been investing in AI for some time. In fact, one of our earliest investments in 2016, 2017 was in a healthcare company that leverages sort of deep compute and machine learning to accelerate drug discovery and to accelerate R&D for therapeutics. So I think it's been quite an active theme, but really what happened in the past 18 months or 12 months is that it became very, very evident that something pretty powerful is working here. And no one has been able to do this so elegantly and so beautifully than OpenAI. And it just really brought the entire industry and the entire technology to the fore. So we're quite excited about it. We're very, very excited about it. In addition to, obviously, we feel and believe this is an important turning point for us, an important moment for us as a sovereign wealth fund to be able to be active and to prove our value to the tech community. we want to take advantage of this very, very disruptive technology, specifically in sectors that, for example, if you step back, what are the sectors that are very important for Abu Dhabi and the UAE? Sectors like energy, healthcare, and these are, remember, technology for us, while is an important investment strategy, technology ultimately we believe is going to be very transformative for our society and our economy. So it's a real strategic, deliberate sector for us. But if you look at healthcare, we are putting in place a very friendly regulatory environment in the healthcare space. So ultimately, how do you leverage the data sets that are, for example, in the UAE, and how do you apply AI to fundamentally create very interesting technologies, accelerate drug discovery, potentially create personalized health tech and healthcare experiences using AI. So I think these are ultimately, we believe this ultimately accelerates our technology journey. And so that's at the national level. I think at the investment, at the global, there's a lot of unknowns still. So like many of the other VCs, we're learning, we're meeting companies. We've invested in some deep compute and machine learning and AI companies in the past. But I think ultimately, where does the value accrue? It's really just very early to tell. So I don't have I'm not smart enough, I think, to predict ultimately where the value accrues. Maybe Lauren, you're probably much smarter than I am, which is why we're an LP in your fund, because not in addition to being a good money manager, we think you guys are very, very smart fintech investors, and obviously, I think AI will play a very big role in financial services and transformation of financial services.
Yep. Yeah, I think we've been thinking about it a lot, and we're quite excited about the role that AI will play in financial services. It's obviously been a sector where for good reason, entrepreneurs aren't quite just throwing things at the wall as they are in other sectors, nor should they be. As Ibrahim said, there's a lot that's unknown, both in the technology and in the evolving regulatory environment around it, and that's obviously extremely important as we think about its applications in fintech and in financial services. But a few of the areas that we think are ripe for disruption earlier in the cycle are certainly fraud detection. We're already seeing a lot of activity there. And what's interesting about that space, unfortunately, is that AI is going to exist on both sides of the equation. So, you're going to have the malicious actors using AI as well, and so it becomes all the more important that tech gets ahead of it. And we're seeing, again, a lot of company formation activity there. We also think that there's opportunity in an area I'd call the sort of AI financial coach. This may be a little bit of sort of, regulatory gray, to be quite candid, because, there's a balance between being, offering support and financial literacy versus advice. And, time will tell whether we'll have, AI agents registered investment advisors. But until then, I think that it's sort of a combination of much more tailored support coupled with financial literacy, and really bridging that gap between consumers and business users and the financial institutions that serve them. Whether there'll be standalone AI companies that offer their own financial products, or whether the value will accrue to sort of the middleware that enables existing financial institutions to adopt the tech, or both. Still time will tell. And I think that obviously financial data and analytics is another interesting space where we're already seeing Bloomberg and others make meaningful strides here. And you talk about democratization of access to financial products. I mean, this is really democratization of financial services as an industry, in terms of enabling people to start hedge funds without teams of analysts. And so I think that there's, we should all expect a lot of transformation in our industry. There are a couple areas that I'm excited about, but I think are longer term. And that includes underwriting for obvious reasons, as well as anything where there's actual management of the underlying transactions. But I do think some of these use cases I mentioned that are earlier on are there are a lot of companies working on them now, and we're excited to see what happens.
And just to build on this, I mean, it would be really interesting that our view is that you're going to start seeing a lot of companies in the US and in Europe that wanted to expand, for example, to the Middle East, whereas previously there was just a lot of friction associated with a number of people. Now AI potentially enables them to move a lot quicker. You don't have to set up with 100 people or 50 people, whether that's like Chime or Stripe, some of the leading fintech companies in the US. You don't have to have a very large workforce between developers and go-to-market. Are you able to streamline that? Can you be a lot more productive with 30, 40, 50% and just have 10 people and be able to sort of enter the market with 10 people? That's a pretty powerful idea and concept and force to be able to do that. So I think that I think is going to be a big shift in our technology companies as they want to expand globally. But I would say, as Lauren is saying, very excited about fintech. Healthcare is probably the most exciting area for us and the role of AI. I was having this chat with one of the leading healthcare investors in the world, Bob Nelson at Arch, and he said that Arch Ventures, and he said, listen, there is no $1 trillion healthcare company today. Why is there no $1 trillion healthcare company today? Why is it that there's these very large platforms that are valued at $500 billion or $1 trillion, but not healthcare? Just given the importance of these healthcare platforms for the future of society, and potentially maybe AI could ultimately be the trigger for that, to create $1 trillion healthcare company globally, because you can potentially accelerate drug development, you can accelerate reach and transform reach to consumers and treating patients. That maybe this is the one shift we've all been waiting for.
Yeah. And going back to productivity, that's a very good point. As early stage investors, now that we're looking at teams, usually the series pre-seed to kind of seed was kind of sizing between 2 to 5 million, given that to a team, have them hire people to kind of work on very specific things within the team. And all of a sudden, they can do that with a 2-person team.
Yeah.
So how are we, as venture investors, also thinking about sizing the very early stage investing side as we work with these teams to expand and get very quickly to their product market fit stage? It's still a question that we're all having as venture investors, and I'm very curious how...
In terms of sizing?
Of sizing the deals very early stage. A lot of functions can be now executed by AI very, very quickly. I mean, you can have AI can help you code and do it very fast and optimize for a lot of things. So all of a sudden, the very early pre-seed to seed team that gets to up to 7 people or 10 people can be 2 or 3.
Yeah. Yeah, I mean, I'll let Lauren comment on the early stage, just because you're a much better early stage investor, I think. But on the growth side, I think the world of $300, $400 million growth rounds that come together in like 10 days or 5 days or 48 hours are gone. Like those days are finished. Investors now want to spend time with companies. They want to understand the fundamentals. They want to get to know the management teams. And I think founders are also recognizing that ultimately these investors that moved very quick to put these term sheets, to put this capital, ultimately were not around when things became very, very challenging and very difficult. So there's this big thing happening in the industry. They're called a lot of companies have orphaned boards. You heard of this? Orphaned boards.
Yeah.
Yeah. So it's like all of a sudden, a lot of these investors are no longer showing up to board meetings because, we moved too quick. We don't really understand this business. We put this money up, so it's not really important for us anymore. And unfortunately, that really hurts the industry because some of these companies could be very valuable, but they need some support and guidance and decisions. And governance is important. So, I think the sizing ultimately gets recalibrated, but I think more than sizing is the role and the mindset and the behaviors of the investor at what we call the growth stage category. But I'll let you comment on early stage and how that's evolved.
Yeah. Well, I mean, from a governance perspective, I would say there's definitely just more of a hunger from entrepreneurs for that input, as you said. And, not only are they wanting, investor board members that are already on the board engaged, but as for the lucky ones that are raising rounds, they're wanting, they're evaluating the investor as an individual and as a board member, and they're thinking more holistically about their boards too. In 2021, very few, especially early stage companies, were adding independence to the board. They really weren't thinking about how to build the boards over time. And now we're seeing more independence being added. I just think that there's a desire among founders for more collaboration and more governance. I also think, to the point around, how this impacts and how AI in particular might impact the sort of sizing and company formation, sizing of rounds and company formation. I think it's really interesting. We're spending a lot of time thinking about this right now. I don't know that, on a nominal basis, the earliest stage rounds are not that big, so I don't know that it changes things all that much, but I do think that that the speed to market is just going to be completely transformed, and the ability to differentiate, you have to differentiate on Chime is an interesting example where their moat initially was honestly that they had a product in market. It was so difficult to build and to launch a bank-like service because the infrastructure required, didn't exist out of the box, and it was so meaningful. And so they really had a head start advantage. That's not going to happen in almost any industry. That's not going to happen anymore, right? And so it's really going to become an execution game and really about the sort of quality of the talent at the top and how they think about differentiating.
To build on this, the one company, obviously, the exhibit A of this is a company called Figma, which got acquired, or I think is getting acquired by Adobe. And the story we all hear is that they've been working on the code and the software for 6 years.
They've been grinding since.
They've been grinding at it for 6-7 years.
Yeah.
And ultimately, can you do that when there's AI and ultimately generative AI can enable companies to be able to build this code in 24 hours? Or what ultimately happens to this entire category of the software industry, or SaaS as we know it? Yeah. So I think there's a lot of change happening there, to your point around just sort of getting product to market and changing that differentiation.
Yeah.
And as we actually have this amazing unregulated wild child AI right now, I think a lot of issues come around trust and what that means. And I think I would love to hear your perspectives about how blockchain could be this yin to this yang of trust issues that we're having with AI, especially on the FinTech side, and how you guys are thinking about that in your book, this intersection of blockchain and AI as we evolve.
Yeah, you guys have a very clear thesis on blockchain that you put forward.
Yeah, we really we look at all of the enabling technologies sort of within our thesis areas, and clearly AI is a big part of that, and blockchain is a big part of it. I think that we're still really interested in applications of blockchain that are really truly taking advantage of the unique characteristics of the technology. So, in addition to investing, in the U.S. In FinTech, we invest internationally in Latin America and other emerging markets. And I think that we still think that especially in some of those economies, the opportunity for things like cross-border payments and the ability to hold more stable currencies. These are things that are real-world problems for people, and that blockchain can uniquely enable. So, we've been thinking about the space, investing in the space for a while. Acrew has been mostly, interestingly, investing because we do FinTech, data and infrastructure, and consumer. We've been mostly investing on the infrastructure side, and on the FinTech side, we've done a bit, but these are really the things that I think we're most bullish on, and continue to sort of wait for the infrastructure to be there to really enable some of these use cases at scale. And then, of course, and we should really be asking you about this for sure, but I think obviously talking about the regulatory environment in AI, clearly in blockchain, this is top of mind for everyone. And I think especially internationally, there's even more of a lag in a lot of a lot of markets abroad in terms of how this will all shake out. So
we're very grateful for a lot of jurisdictions abroad that have been doing a lot of great work,
yeah,
enabling our space, obviously. I mean, the UAE, one of them, has been kind of a leader in the space. Europe. So we'll see how things go. I think we're almost running out of time, so I'd love to just very quickly hear from your perspective as a sovereign fund, basically. How are you investing through 24-25 for this audience to just get a sense of how are you guys thinking about the next 2 years?
Yeah, I mean, I think, in summary, we are very active. We're leaning in. We're committed to innovation. We're sort of on offense. Now, we're, in the spirit of being also genuine and honest about some of our challenges, we're triaging our portfolio, a lot of the companies that need help and need some guidance. But we are on offense. We're investing in FinTech and healthcare. A lot of it is underpinned by AI. The UAE has made a very important decision to make crypto as a global center. It's no secret that a lot of the big crypto companies here are now going to the UAE. So I think these are all important disruptive areas that we'll continue to invest in. But ultimately, what I just want to wrap up with this is just our ability to work deep in the community with founders, but even with partners like Lauren, and have this kind of dialogue will continue to be core to what we do as we build our business.
Thank you. Lauren?
Yeah. Well, I guess I'll start with my somewhat contrarian perspective on what we're excited about in the next year or two, which is I believe the next big consumer FinTech platform is going to be built in the coming years. It's interesting, at the beginning of the year, we did this analysis looking at other VC funds' predictions around FinTech, and everyone is focused on infrastructure and on SaaS for the CFO org for good reason. But when you think about the sort of ingredients, so to speak, right now, the fact that we're in a period of macroeconomic volatility and that really impacts consumers' financial psychology, the fact that Gen Z is coming of age, and then that we have this major technology shift happening, all three of those things at the same time, to me, means we have a next wave of consumer FinTech upon us. And it really parallels, actually, what happened a decade plus ago when the chimes of the world were built, right? We were coming out of the GFC, millennials were coming of age, and mobile as a platform was really accelerating. And so, to me, that's actually what I'm excited about. And most of my VC peers would tell me I'm crazy, but I really think that's where the next big ones are coming. And more generally, I would agree with Ibrahim. I think that what we're really focused on is for the next year is supporting our companies, working with our great partners, and really having a collaborative process, in terms of supporting those companies. One of Ibrahim's colleagues and I are work together on a board, and spend a lot of time sort of just sitting and dialoguing and brainstorming with the founder on really how they're going to get to sort of that next key milestone. And I think that's so much of what this year is about. It's about that deep collaboration, and excited and grateful to have partners like you all. So.
A great note to end on. Thank you, guys. Thanks for joining us. Thank you.